I'm Eleanor Hill, editor of Treasury Management International, and I'll be the moderator for our discussion today on in-house banks. We've got an all-star panel, Deepa, Jim, Kelvin, and Peter, with years of experience in in-house banking. So we'll look to share some best practices with you. We'll talk through some of the challenges associated with in-house bank implementations and how these can be overcome. We'll also examine the evolution of in-house banks given the rapidly evolving technology landscape. Without further ado, I'd like to introduce our panelists, or rather put them to work already and get them to introduce themselves. So Deepa, please could you just give us a quick overview of your current role?
Sure. Hi, I'm Deepa Palamutham, Director of Tax and Treasury Technology and Controls at Intel. Prior to June this year, I was managing the cash operations, technology, and controls for Treasury, which is where my involvement with the in-house bank project came into play.
Perfect. Thank you. Jim?
Hey, everyone. My name is Jim Skurlock. I'm the Director and Head of Cash Management at Microsoft. My responsibility at Microsoft is managing the cash flow and banking activities of our worldwide 450 subsidiaries. Responsible for supporting all of our intercompany lending activity, which is really where having our in-house bank is kind of fundamental.
Excellent stuff. Thank you. Kelvin, over to you.
Hi, my name is Kelvin Ang. I'm the Principal Treasury Advisory Group of Citi. I'm based in New York, and basically my role is providing advisory services to Citi clients on anything that's corporate treasury. So I have worked in corporate treasury space for about 20 years in the past with various multinational corporations in various multiple treasury functions. Thank you.
Thank you. And Peter, over to you.
Hello, everyone. My name is Peter Wolf. I'm a Senior Vice President with Serrala. We're leading implementers of SAP Treasury and banking software and support across the landscape in the financial services area, accounts payable, accounts receivable, and processes both on services and on software. I've personally been focused in the area of SAP Treasury and risk management for the last 20 plus years. So this area of in-house banking is a niche within the niche of Treasury that has been my specialty.
Excellent stuff. Thank you. So we're going to dive right in and learn a little bit about Intel and Microsoft's in-house bank journeys, first of all. So Deepa, if I can come to you, would you mind outlining your sort of treasury finance landscape, your systems, etc., and then maybe share with us a little bit about the history of your in-house bank, when it was set up, and some of the major benefits that Intel has seen? That would be great.
Sure. So Quantum is our treasury management system, and SAP is our ERP system. Our journey towards the in-house bank solution began in 2013, when we had multiple notional cash pools offshore. After our treasurer initiated the consolidation of pools for efficiency and other benefits, we benchmarked with multiple peers, brainstormed with legal and tax, and it was decided that having a single offshore pool and an onshore pool will be ideal for us. We had approximately 200 participants across 50 countries. Now, considering we had investments in the offshore pools, decision was made to wind down the investments in the existing pools and form the single offshore pool. At that point in time, since we did not get prioritized amongst the competing projects on SAP, decision was made to still move forward and create a custom solution in Quantum. We were very successful in doing so, and for this significant effort, the team won the Adam Smith Award in 2014. Now, fast forward to 2016, when we were looking for efficiencies and we were completely on a mission to end of life any custom solutions, we approached our IT department again, and this time we got the go-ahead to implement a solution on SAP. Now, again, after benchmarking with peer companies, we worked on hiring the right consultant, which is a critical component of the successful implementation, and embarked not only on the Quantum migration to SAP, but also getting the true ROI of the solution in SAP, which for us was cashless settlement. Now, in a way, the solution is unique to us because all the cash flow, at least I think it's unique, is because all the cash flow information from SAP flows into Quantum, and the physical cash movements are made out of Quantum. So basically, Quantum is our payment system. And the solution works and has been functional for almost 3 years now. In terms of benefits, I think not having a custom solution, making the life of our intercompany accountants much simpler, concentrating liquidity and investment flows into fewer accounts and streamlining the work for cash managers, and enabling the optimization of ECR would be a few of the benefits. And of course, I did mention the cashless settlements, which was one of the major benefits.
Absolutely. Brilliant. Deepa, thank you for that overview. And I know we'll get into some of the challenges and the intricacies of your Quantum setup a little bit later. But Jim, let's come over to you and have the same question. Perhaps you could highlight some of the differences between Microsoft's in-house bank and what Deepa's described.
That sounds great. It's always fascinating to hear about how different companies set up their in-house bank a little differently. At Microsoft, we actually have 2 cash centers. We implemented our foreign cash pool in 2006. And then a few years later, when we launched our Pay on Behalf initiative, we actually set up a US cash pool in 2009. To set the stage a little bit, I thought it would be helpful to kind of share how we're structured. We have about 500 different legal entities globally. We do business in 191 countries, and we have a physical presence in 118 countries. We are actually pretty lean. We have about 1,300 bank accounts with about 85 banking partners, and it's mostly just because of the countries that we're in sometimes require in a local account with the resident with bank. But our global footprint for our treasury structure is actually very lean. We have 42 employees globally. Nearly our entire treasury function of around 40 people are located in the greater Seattle, Washington area. But we do have 2 critical members of the team, and we have 1 person in Dublin and another in Singapore that are generalists that help support a wide variety of functions, including cash management, trade finance, and some of our bank guarantee issuance to help support the field. Our cash management team in Treasury is responsible for managing the intercompany lending of all of our worldwide legal entities. And nearly all of our main legal entities and our operating accounts participate in the in-house bank to some extent. A little bit different than Intel. We actually do physical pooling versus notional. So our main foreign entity behind our in-house bank actually has non-resident bank accounts throughout the world, and we physically sweep cash and leverage the cash in concert with our balance sheet hedging program to then fund our operations. One of the most important functions that we have is really to ensure compliance from a stat and tax structure. So for all of our 450 participants within the in-house bank, we've assigned them like a tier structure, and the level of participation within the in-house bank depends significantly on the local regulations. So as an example, for many Western European countries and in the US, where there's limited capital controls that prevent us from moving money in and out of these countries, and they're also able to do intercompany lending, these are really considered full participants within our in-house bank. And as you know, and one of the key functions of having our in-house bank is we provide an arm's length interest to them. And now, as the capital controls increase, in specific countries and there are currency controls, the level of participation, declines.
Yeah, absolutely. So, Jim, thank you. It's good to have a bit of a contrast there from what Deepa's doing. Now, Kelvin, I'd like to bring you into the conversation. Sorry, go on, Deepa.
Sorry, I just had a quick comment on what Jim said. So we used to have notional cash pooling, and then we moved to physical cash pool after the in-house bank solution was implemented. So just wanted to make that. I think Jim pointed that out.
Oh, thank you.
Perfect. Thanks for the clarification. That's great. So Kelvin, let's talk a little bit about in-house banks and the momentum behind them at the moment. So do you see that COVID-19 has sort of driven greater interest in in-house banks? Is that what you're hearing from your clients?
Yes, more recently, yes, I would say that's the case. A number of corporates have either asked for more information on in-house banks, or they've requested us to help them determine the scope of their in-house banks. Now, COVID-19 kind of brought the world to its knees, to a standstill initially, whereby the focus was really to function and operate smoothly from home. And that's what most of us are still doing now. As you can see, all of us are working from our homes still. But within a matter of weeks or months for some, the realization of driving a greater efficiency in liquidity, working capital management hit hard. And so, the treasurers and companies were making lists of where they have excess cash, wherever they are, how to gain control of those cash. Treasurers were also concerned with customer credits as well as the financial health of their suppliers. For the corporates, I would say, that have quite, in a way, surmounted or conquered or overcome the COVID operational challenges today, those with sufficient resource, as well as a clear need to drive liquidity and working capital improvements, I would say that they are seriously kind of exploring in-house banks as a solution.
Yeah, definitely. Peter, be good to get your views on that, and maybe what kind of benefits could in-house banks bring to corporates in this new normal, as it's being called?
Yeah, so I think kind of adding on to what Kelvin just mentioned, when I think about the new normal in business, people are really focused on that right now, the COVID situation. But I think the new normal really has established itself over, let's say, the last 10 years or 12 years since the previous financial crisis in 2008. Although we have a couple major crises, the COVID, the financial crisis of 2008, that stand out, especially in between. We've essentially had mini crises pretty much every year. Financial crises, the European debt crisis, the Turkey currency crisis, the Latin American debt crisis, the Greek crisis. All of these things together have established a new normal of volatility and increased risk. So when I think about the new normal and what organizations need to do to survive and to adapt and to excel in that kind of environment, there are a couple topics that are especially critical in my view. First and foremost is really the increased need for control, visibility, and heightened risk management. Kelvin mentioned these topics. These areas across processes such as payments, cash management, foreign currency exposure, counterparty exposure, this has been increased. The need for the focus on this has been substantially increased because of the uncertainty, the volatility that has become the new normal, is pretty much established as an ongoing standard. The second is increased need to emphasize and focus on optimizing liquidity management. And again, I think really all the other panelists talked to this point about liquidity management and the need to be able to manage your cash effectively across the entire organization to ensure that you have liquidity where you need it, when you need it, in the currencies that you need it. When you look at all of these things, in-house banking solutions, models, and the combination of processes, structures, and technologies provide the capability to address these issues in a substantial way. So optimally structured in-house banking solutions, leveraging the right technology enables you to increase your control, increase your visibility, to increase efficiencies that enable you to be able to more effectively manage your liquidity across the enterprise, make funds available where they are needed at the appropriate times, and to increase your ability to mitigate your risk, fraud risk, counterparty risk, currency risk, because all those things become centralized through these processes, and that enables you to establish these processes and controls that otherwise would be very difficult to establish. So I think from that perspective, there's huge benefits from in-house banking in this environment.
Yeah, absolutely, Peter. Excellent summary of the benefits there. It would be good to understand a little bit more about how Intel has actually achieved some of these benefits. And Deepa, coming to you, you mentioned quantum earlier. So how challenging was it to implement the in-house bank using quantum, and what changed when you implemented in-house cash in SAP? And also, what advice would you give to our listeners around making their in-house bank journey as smooth as possible from a systems perspective?
Sure. So I think creating a custom module in quantum was challenging for sure. We were testing the limits of the system. The team at Intel needed deep expertise on end-to-end working of quantum to put in the legal entity structure, bank account structure in place. We worked in partnership with the bank to automate the booking of sweeps, whereby the incoming ZBA and sweep messages came in with a custom code from the bank's end. This actually helped us to identify the USD and cross-currency sweeps, which in turn made it easy to interface into Quantum and avoiding any manual intervention after the sweep was recorded. So it took a bit of negotiation with the bank to come up with this innovative solution. And, 6-7 years back, it was an innovative solution. I don't know whether they do this as the norm now. Now, though not an easy task to get everything aligned, the solution was successfully implemented, and we were in production in Quantum for 3 years after spending about a year to implement. Now, when we moved to in-house bank in SAP, similar, we did everything that was same in Quantum, kind of an as-is, but on top of that, we added an add-on solution to get the cash flows from SAP into Quantum, because it's still our treasury management system. And an additional add-on was to build a user-friendly GUI for various users to request cash and have it approved. So it's a very, it removes the pain point of you being a proper user on SAP. And of course, cashless settlements was another benefit of moving into SAP from Quantum. Now, if someone is embarking on the in-house bank implementation journey, I'd say beginning with executive management sponsorship, tax, legal, and treasury getting together to figure out what entities can participate under what structure, working on the intercompany loan agreements, POBO, ROBO evaluation needs to be done. Choosing the right consultant, I think is critical. Getting a dedicated project manager who understands treasury and can make and influence decisions, this is very critical. 2 to 3 dedicated subject matter experts on the treasury side, accounting and IT support to handle end-to-end implementation would help the project become a successful one. In the end, it's all about the people. For us, POBO was already in place. Robo is not as significant for us due to our streamlined collection strategy and being a dollar-based company. But if it's important to other companies, that's another area that they would need to spend some time with that.
Absolutely. And Deepa, if you were to do it all again, would you go through the same Quantum process? Has it been rewarding enough?
I think so. So I could talk about it that it was a phased approach, not by choice. We were competing against other projects on SAP, and it's all about the IT resources and budgeting. So we still needed to move forward. That was the choice that we made.
Yeah. Peter, I'll just bring you in quickly here. I just wondered if you had any observations on the Intel journey and Serrala's sort of involvement in it.
Yeah, fortunately, we were engaged as the system implementation partner, solution design partner for Intel and Microsoft as well, but specifically with regard to the comments that Deepa made. Their situation was unique, or not unique, but I mean, it is somewhat different, certainly different than Microsoft's, in that Microsoft was heavily focused in the treasury platform aspects and cash management aspects in SAP, as well as the in-house banking in SAP, whereas Intel leveraged the Quantum solution. And so there were some additional challenges there, but challenges that we were certainly able to overcome to integrate the solutions. And I think the benefits that they received from the in-house banking, SAP's in-house banking, the integration to accounts payable, accounts receivable, to automate the processes from end to end, the clearing, which is a huge, typically a huge time burden for companies, and creates risk and issues with errors and just inefficiency overall, that they were able to maximize and take advantage of those aspects, and using the efficiencies and opportunities within SAP to leverage that integration, while also integrating into the platform of choice for them for Treasury. So really Intel got the best of both worlds for them, that they wanted to stay with the quantum platform. At the same time, they wanted to get the benefits of in-house banking and SAP. And I think being able to bring them together was expertise that we brought to the table, and being able to leverage those interfaces and optimize the solution.
Yeah, it works really well. Excellent stuff. Now, Jim, at Microsoft, it's a little bit different. So tell us, first of all, about your systems landscape, because I know you use a fair bit of your own technology. And is that a help or a hindrance when it comes to the in-house bank? And where does Serrala fit in?
No, good point. So at Microsoft, we do use SAP as our system of record. And in order to run our business, we leverage around 40 different applications. And unlike most corporate treasuries, we actually don't have a standard treasury management system. In order, we still leverage many of the same third-party tools that many of you all do. I mean, such as Bloomberg, FX, FXall, Reval, just to name a few. But due to our own complexity, we really, over the course of the last 10 years, decided to make the strategic decision to build our own first-party applications. So we designed a suite of cloud-based applications that actually work very, very well together. So some of the tools are our bank account administration tool, a tool to manage company loans that are not in the in-house bank, wire request tools, to name a few. And it was right, earlier on when he said that volatility is the new normal. And I think that's one of the reasons that drove us to many of these solutions. So Microsoft is a technology company, but we also have and so one of the things that we have done is, leveraging some of the applications in SAP is we take a lot of our information that's in SAP and our in-house bank, and we feed it into a Treasury data lake. And, and some of those core items are going to be bank account balances, loan exposures, all of the core things that a Treasury management team would need to do, from, managing daily cash positioning to just being able to see all of our exposures. And by having that information all together as once, this actually really does make a more powerful application, because once you've taken all your data and you're storing it in the cloud, one of the great opportunity you've now been able to do is leverage on Microsoft Power, kind of our data visualization software. So we have information that's being populated nearly real time, and by having a data visualization application on top of this, it has allowed us to be able to create a variety of customizable dashboards. So at any particular point in time, when Peter was talking about the Turkey crisis or the Arab Spring, the issues that we have in Greece, as a treasury management role, we've always had to adjust very, very quickly. And the last 10 years has, definitely on the new normal, where we're almost required to be able to provide information real time. And by having a lot of information, we can create customizable dashboards, which significantly improve our, response times. So now if somebody wanted to know within, if, about a specific bank that's in the news or a specific country in the news, it takes us less than, a minute to be able to provide that analysis for them. Wow. And so and some of the things have been great. And I think this is super important because, I don't think the in-house bank is necessarily a hindrance, because I think the in-house bank is actually fundamentally do. And I know I'll hit on it in a little bit, but we haven't been, it's absolutely cool, housing our, a lot of our other applications.
Yeah, brilliant. So apologies, we're getting a little bit of interference. And Peter, I'm just going to come back to you for a minute and wondered if you could highlight some of the sort of challenges with the Microsoft journey and, again, the Serrala involvement. That would be great.
Well, I would say, first of all, Microsoft was one of the early adopters in the early 2000s. Really, when you look back in the history of in-house banking, it was the late 90s. SAP developed their solution, their in-house cash solution, which is their model for technology for managing in-house banking. And adoption in those days was very minimal. There were some companies that were on the cutting edge that started to go down this path. Most companies were pushing back on concerns about tax implications. Microsoft was an early adopter, so we were still really in the infancy of building these solutions, these structures, and trying to figure out how to optimize them. Microsoft, to their credit, as was noted by Jim, they use a lot of their own technology. So finding that right balance of their technology combined with SAP technology and what was available in products and solutions by the banks to produce an optimal solution back then in 2000 was definitely cutting edge. The thing that's been, I think, really impressive with Microsoft and Jim in particular is driving that organization to constantly be on the forefront, on the cutting edge of what's available to optimize their solutions. They've won several awards. They just won the Alexander Hamilton Award last year, I think, or earlier this year, for exactly that, cash management. And I feel very proud that we were the partners that helped them to build that initial bank. And then over the years, over the last essentially 15, 20 years, we've been constantly supporting them and expanding that solution. So as technology changed, as the products and offerings changed, as Microsoft created new structures and found ways to take better advantage from a tax and a risk management perspective, we were there assisting in utilizing and helping them to identify how they could utilize SAP technology to take advantage of that. So they've morphed their bank, their in-house bank, over the years, expanded it, changed it, constantly taking advantage of new functionality in SAP and their new structures and designs. So that's extremely impressive and great for example for other companies to look to learn from.
Thank you. And Jim, just coming back to you very quickly, would you mind outlining a few of the challenges that you face as such a global, highly acquisitive organization with all of the currencies that you manage? And could you maybe give a little bit of advice to the listeners around setting up an in-house bank in that kind of challenging environment? Oh, I believe we may have lost Jim. So, Kelvin, I'll come to you. I'll come to you and just wondered if maybe you could pick up on that theme around the challenges that multinational companies might experience in a sort of multi-country, multi-currency, multi-bank environment when they're looking to set up an in-house bank. And how can these challenges be overcome? And what is the role of a bank like Citi in helping corporates to achieve this?
No, absolutely. I think let's break this question down. It's a complex question, by the way. Let's break it down into regulatory, tax, and operational, treasury operational. When we look at MNCs today, as what Deepa and Jim has basically explained the structure of Intel as well as Microsoft. MNCs today operate in a very complex global environment. It's fast changing in terms of the rules of regulatory changes, the tax rules as well. Now, to provide a perspective on this, tax authorities have been especially watchful, especially in recent years, over transfer pricing practices, profit shifting schemes that may potentially erode the profit base of the countries where some of these MNCs operate and sell in those markets. Now, in short, not to go into a tax conversation, this is not a tax webinar, this is a treasury. The end result is really selling through the local subsidiaries, and in many cases, in the local currency. Now, this actually impacts quite a lot of companies these days, especially when we think about the digital economy, when we think about the gig economy, when we think about marketplaces and things like that. Where are the markets? The lines are pretty blurred, right? So it has to be drawn in such a way whereby these things, where is it sold in, from which entity and from where? Think about the complexity of all this in the world that we live in today. Now, treasurers are already challenged by the multi-country, multi-currency, and we heard how many countries Microsoft and Intel are in, how many legal entities that they have. When you start to think about this, these are all challenges that treasurers really have. Now, to add on to this complexity, the culture of some companies, as I have seen, it is more decentralized. What it means is that there would be some authorities given to perhaps the finance people in the country, and they would decide on treasury matters as well. And when that happens, these treasurers eventually have to deal with the multiple bank relationships, right? Because they would be making decisions on which bank that they want to work with. Now, that is basically the culture, the treasury operations, the tax rules. Now, regulations do play a part, right? So as we know, For example, there will be those tax payments whereby it has to be paid out of specific banks, as an example.
Yeah.
And also, basically, in terms of some of the other practices that we've seen, like how some of the, I would say the banks, when they actually basically have to go into areas like, for example, I would say, other than tax payments, like even foreign currency payments, right? Jim talked about offshore bank accounts. Can those payments be made from offshore accounts into onshore and things like that? So these are all basically very realistic complexities that treasurers have to face. So all in all, basically the environment that treasuries and treasurers work in is extremely complex these days. Now, how do banks like Citi basically come in? Obviously, in terms of the footprint, first of all, in terms of the complexity in the footprint, we try to have to match their locations as much as possible to support them from both a global perspective, regional perspective, as well as a local perspective. So I think that is extremely critical. Because when you start to think about in-house banks, there are things whereby may require local support on the ground, especially where regulatory needs are concerned. As an example, you need to sweep cash out of certain, I would say, more regulated countries. What ends up happening is that there might be regulatory approval that could be required, even though it may be one-off, or it could be regular regulatory reporting that might be required before the sweeps can be done. And so these are some examples whereby global banks can actually provide support. The other area of supporting is basically to continually provide the services and the products that could potentially help MNCs. And Deepa spoke a lot about Pobo Robo and Jim as well. Now, when you think about Pobo Robo, obviously one of the key things is that companies, they themselves can actually set up the structure, they can actually set up the process, they can actually do it themselves. But global banks like Citi can actually enable that. So we could enable it by making it easier and smoother and much easier from an operational perspective to basically achieve the same result as a Pobo Robo by using virtual accounts, as an example. And so, these are some of the examples that I could give in terms of how basically global banks like Citi could play a role in terms of basically supporting global companies like Intel and Microsoft, in terms of working and partnering together.
Thank you, Kelvin. That's great. Jim, I'll bring you back into the discussion now. Did some of that ring a bell with you, some of the challenges that Kelvin was outlining in terms of this sort of, you work in a very global, very dynamic, highly acquisitive organization. You've got a lot of cross-border flows, cross-currency. So maybe share with us a little bit about some of the challenges you've experienced in that world that Kelvin was describing there.
Yeah, absolutely. So as I mentioned earlier, we have about 42 people in Treasury globally. What most people may not realize is that Microsoft is a very acquisitive company. And for the last several years, we've consistently acquired a new company about every 3 weeks. And one of the constants...
You say that so casually. It's brilliant, yeah.
It's the new normal. And one thing that's constant with each deal is we do, even though we have a variety of standalone companies, the one core thing that we do integrate from almost day one is the treasury function. And there's, without our in-house bank, there's absolutely no way that we would have been able to scale. Our in-house bank has really allowed us to, have a centralized system where we're, managing the intercompany lending activity for all of our, subsidiaries, acquisitions as well, being able to settle a lot of the transactions with non-cash. If we didn't have to do that, with the amount of intercompany that we have as a company is pretty amazing. We would have to do, tens of thousands of wires, monthly, if we weren't on a physical or on a in-house banking solution. And our in-house banking solution has really allowed us to be able to automate many, many more things than we kind of ever anticipated when we first implemented the solution in 2006. So we do use our in-house bank principally as an intercompany lending structure, where then we're able to net a lot of our intercompany. And one of the items that we're really proud about is Peter was talking about like the euro crisis and a variety of other things is right around the early, right around 2010. One of the items that we started implementing was an automated zero balance account structure. And for anybody in Treasury, a zero balance account structure is absolutely nothing new. It's the very simple standard bank product. But where we did this a little different at the time was because we do physical pooling, we were the first corporate to actually have a zero balance account structure going across different legal entities, across countries, all with 100% automated accounting. And it was the automated accounting piece that was, super fundamental because, you could physically sometimes move the transaction and be able to have a record of the transaction, but to be able to have the accountant sign off on this was, I think, pretty powerful. So what this has really allowed us to do is have a mechanism to be able to support, more than half of our subsidiaries globally. So of our, roughly 1,300 bank accounts, nearly 700 of them or more are set up on an automated zero balance account structure feeding directly to our cash pool. And this has really allowed us to scale because now we use these mechanisms to be able to sweep cash from our subsidiaries and our collection accounts that we have around, globally. We also use this the other direction as well, where we're able to provide a just-in-time funding model for our subsidiaries, which is fantastic.
Okay.
So as cash leaves the specific markets, we're able to provide that just-in-time funding, which really helps automate so many of the activities that we would be doing from a treasury function.
Excellent stuff. Now, Peter, let me bring you in and just wondered if you could share some pearls of wisdom with us because you've worked on countless in-house bank implementations with clients. So tell us a little bit more about the role of SAP and Serrala in overcoming some of the challenges that we've discussed already.
Absolutely, and I'd really like to tie it in. Jim, I just wrote a bunch of notes down because he was bringing up so many key topics of where we see companies being able to benefit from SAP's in-house cash technology and marrying that with appropriate structures and processes. And I think one of the thing that we bring to the table, Serrala, is our expertise over 20 years of supporting organizations like Intel and Microsoft in identifying how to marry technology with process and structure. And so the identifying how you can take the optimal advantage of these functions and capabilities within the system is a critical aspect. And having been on literally hundreds of projects for organizations like the ones on here, it has given us an insight that allows us to bring information and view of opportunity to leverage technology to support exactly those kinds of structures. Let me just talk a little bit about specific things that Jim brought up. The in-house cash solution that SAP delivers or has available and add-on solutions that we as Serrala bring to the table to enhance that. The capability to leverage that in this acquisitive environment, as Jim was saying, the solution is really adaptive to be able to bring companies into this model, into the in-house banking structure very quickly, even if they aren't on SAP. You can bring them into the in-house cash, in-house banking structure to take advantage of centralizing their cash, to enable the ability to just-in-time fund and to optimize liquidity management across the organization. So we see companies like Microsoft reaping tremendous benefits of that core in-house banking solution, in-house cash, leveraging in-house cash technology. And the part that Jim talked about that's really just behind the scenes, you take it for granted, but in reality it's a huge benefit, is this automation of accounting. So companies can set up ZBA structures. That's not a problem. Obviously, Microsoft's on the leading edge with the cross-country, cross-currency, cross-company code zero balancing and automation. But if you don't have a system that can, behind the scenes, efficiently capture all that and account for it, you have yourself a nightmare because when balances move, they don't move as exact amounts, $5 million here, $6 million there. It's $5,287,642.82. And someone keying that in manually or plugging those things into an intercompany loan into the general ledger, there's huge inefficiencies and also risk of errors there. So the SAP technology allows you to read the bank statements, automatically incorporate that into the in-house bank, into the balances, into the intercompany loans, into the general ledger with tremendous efficiency and accuracy. And so I think that scalability that Jim talked about, the ability to capture that efficiently and take advantage of that, that's the kind of information and insight that we bring, that we're able to help our clients to achieve how to optimize that technology and to integrate that with their processes in an optimal manner.
Good stuff, Peter. Thank you. So I'm going to jump into the future a little bit now and look at what your plans might be going forward. And Deepa, we mentioned Robo very briefly earlier, and I believe you're looking to implement virtual accounts and robo operations in the future. So tell us a little bit about your plans here. What's your ultimate goal, and what are the hurdles that you might need to overcome?
Sure. So we see a benefit in implementing virtual accounts for account rationalization, easier reconciliation, etc. Though when we're going through the explore phase right now, we have to take a look at this in the broader context of our SAP roadmap to figure out if the ROI compares to the multiple competing projects across the company. So we are still in the initial phase of evaluating. And at this stage, I know it's the right thing to do directionally. Just the timing of the implementation needs to be decided. Now, on Robo, as I mentioned, we are a dollar-based company, and we have very streamlined receivables. So Robo has not proven to have any additional ROI at this point.
Okay. And Jim, tell us a little bit about your thinking, because I believe you're in a similar position. Are you kind of proceeding with caution? Are you ready to roll? Whereabouts are you?
Good point. So we've been looking at both solutions for the last several years, pretty in depth. We've actually been looking at them, together as a solution, but also as standalone solutions as well. And I think both solutions would actually have a significant opportunity to provide impact to the company. The main challenge that we actually face across so many of them is we collect, we're definitely not all dollars, and we collect a significant amount of cash through our regional operating centers. We have a lot of limited risk distributors or buy-sell entities around the world, as well as local our sales and marketing subsidiaries throughout the globe that actually collect in a variety of local currencies. Now, what we've found in the past several years is our bank account partners have made significant strides in their virtual account offerings, but there's not a one-size-fits-all solution yet. And sometimes a lot of their solutions are specifically limited to some of the money center markets and specific currencies, and we just really haven't found a really robust solution yet. And it's something that we're actively working with all of our banks on, and they've made really good strides on this. But we are proceeding with caution as well, because anytime that we're changing our AR flows, it's something that we need to be very cautious about and try to figure out how we limit the impact to the customer. So we're still on a journey. We have a little bit of time on this, and I'd rather make sure that we do it right.
Yeah, absolutely. Makes sense. So Kelvin, let's bring you in and hear a little bit from you about what forward-thinking corporates are looking at in terms of new treasury strategies. They're embracing real-time treasury. How do you see in-house banks developing in this 24/7, 365 environment? And what is the role of banks like Citi in helping clients to achieve their future goals?
Yeah. So when I first, it's kind of funny you mentioned 24/7, 365. So when I first started off my treasury career, indeed it was a 5-day work week. So you have a start time, and you kind of in a way do watch a little bit of the time. And then as you start to go global, you lose a bit of that time into the evening of the day. But now when we start to talk about real-time treasury, real-time liquidity, what does it mean? As you rightly pointed out, Eleanor, it's 24/7, it's real-time, it's all the time, even while we're sleeping, round the clock, because global companies run operations all over the world. They never sleep. It never stops, right? And so the demand for real-time information has accelerated quite a fair bit in recent times with APIs. and also driven by a number of companies whereby their trading model or their business model demands it or requires real-time kind of transactions. They need to make payments out in real time. Some companies are also increasingly looking to wow their customers by providing real-time refunds to the customers and giving back money back to the customers as quickly as possible. So all these developments and all these kind of some are basically consumer driven, some are basically business driven, are basically kind of driving innovation towards a point whereby even banks like us have to think, what do companies like Microsoft, Intel, and others, right, of their size, of their global scale, what kind of solutions would they need? What are they thinking about? What are they requiring? And so basically, I think the space of real-time treasury, real-time liquidity, real-time payments, basically will grow. It will grow into the in-house banks at some point in time because the boundary of time will break down to a point whereby there is no cut-off time, right? So as you start to think about placing a deposit or basically a sweep, right now we're still dealing with cut-off time because it has to deal with the particular market and the currency at that point in time. But when you start to think about real-time liquidity, there's no concept of cut-off time anymore. So everything is kind of transaction by transaction. So I think this is really a space whereby systems is extremely important. I think Peter made a point earlier on that with all these transactions and all this myriad of things going on back and forth all over the world, cross-border and things like that, you absolutely cannot achieve it without a good system to track all this. It's not just tracking, but to account for it and to kind of, in a way, make it all the way through to intercompany loans and things like that. So all these processes have to basically fall in together. It is something that will happen eventually in the future, and I'm pretty sure it will come at some point with some futuristic or forward-looking companies to drive this. It will come sooner than later.
Yeah, brilliant. Kelvin, thank you. And Peter, you're lucky enough to see sort of the cutting edge of innovation a lot. So are there any exciting in-house bank-related developments happening at the moment that you want to share with the audience?
Yeah, there certainly are. I think first I would just say, I think what's exciting is that more and more organizations are taking advantage of in-house banking structures and processes because they do provide such tremendous value. So the fact that panel discussions like this and just companies out there who are on the leading cutting edge showing that you can benefit, achieve tremendous benefits by instituting structures like this, it gives awareness, and then other companies look and delve into these areas and identify how they can benefit. So I think that's exciting in itself that more organizations are taking advantage. But I would say from specific technology or specific advancements that are benefiting in this area, I think technology advancements, not just in SAP, but technology advancements across the landscape that greatly increase functionality, efficiency, control, are occurring at a tremendous pace. So when you look at what was mentioned earlier, VAM, virtual account management, that was really a fringe product available at very few banks. Now it's become the norm, and that has opened up tremendous opportunities to enhance your capabilities within in-house banking structure. Specifically, we're talking about receipts on behalf. That historically has been an extremely challenging area for companies to reap benefits. Everybody or most people know with receipts, when you're managing those receipts, identifying where they should be applied to what invoices for what companies, or if you're receiving into a single company, what customers is challenging. So when you try to then combine them into centralized bank accounts, then you have to add on the complexity of figuring out which companies get a portion of that payment or is the whole payment for different companies, and that is extremely difficult. With the VAM structures, you can use them with in-house bank. You still only have a limited number of actual bank accounts, but to the outside world, you have these sub-accounts that essentially work like lockboxes, where the customer is self-directing the payment to a specific identifier that then lets you apply those funds in a much more effective manner. And you can do this down to the level of the customer. They have their own individual VAM account in your structure for that customer. So that's a huge advantage. So we're seeing companies moving in that direction now. When you look at that combined with other technologies like Serrala's Auto Bank, where we're increasing robotics and artificial intelligence to be able to pull information from so many different sources, from emails, from websites, from EDI, electronic data interchange delivery, and incorporate that with banking to be able to recognize and appropriately apply funds in a very effective manner. When you combine that with a VAM solution, just tremendous power. So I think that's a very exciting area.
Brilliant.
I think also the increased ability to integrate systems, SAP to banking, SAP to Treasury platforms, to FX trading platforms, to interest rate and investment platforms, etc.
Ecosystem,
all that is hugely valuable, because it makes those processes efficient, more controlled, and much more effective. It minimizes risk, minimizes the risk of errors and fraud. And so when you look at that technology now, much more plug-and-play capability to integrate those systems, and when you add in the real-time aspect that is occurring now with much more frequency, real-time banking, real-time bank statements, where you get the visibility to transactions much more quickly, real-time payments, where you can execute and have resolution and know that it's effectively completed. Those, when you combine all that together, I mean, it's a very exciting time when you look at in-house banking and being able to make all these processes so effective, so controlled, so efficient in this new technological world. And finding the way to marry those again together, I think, is the really challenging part, understanding the right balance.
Peter, I'm going to stop you there. Sorry.
Yeah.
Peter, I'm going to stop you there. I know it's exciting and we've got lots to say, but in the interest of time, I'm just going to jump ahead and bring Deepa and Jim back into the conversation. I just wanted to sort of share a few best practice tips with the audience before we wrap up. So you mentioned, Deepa, earlier about the sort of phased implementation of your in-house bank, and how important do you think that is, and how beneficial was it to have a phased approach?
Our first phase was consolidating our offshore pools into one, building the structure, getting all the required approvals from legal and tax, and building the solution. And second phase was implementing it in SAP with cashless settlements. Now, this phased approach was the best we could do to meet our objective and overcome the constraints we had at that time. It was not our first choice to do a phased approach, just the circumstances.
Okay. And Jim, your experience?
We did a sort of a phased approach where we implemented our foreign cash pool in 2006, and then we implemented our U.S. cash pool in 2009, and that really was as a result of us launching a pay on behalf, and there were some nuances that really required us to set up a more automated structure to really ensure compliance from a tax perspective. So that was mainly the reason for doing implementing kind of ours in a phased approach.
Okay. Would you have preferred to do it in a big bang? Would that have been the ideal for you, or did it?
I think so. I think that at the time, taking a stand back, if we had to do it all over again, I think a big bang approach would have been helpful. I think it might have also led to a longer implementation, just because when we're implementing our in-house bank solution, there's kind of a unique set of stakeholders. And now that we would implement the pay on behalf, it's an entirely different set. And I think there are benefits too of maybe taking something and doing it in smaller chunks and having an easier win. But I think if we had to do it all over again, maybe one approach would probably be easier.
Okay. And another best practice point you mentioned, Deepa, was the sort of people aspect of in-house bank implementation and making sure that you've got buy-in. So just wondered if you had any sort of insights that you could share on the importance of having a cross-functional team, and any tips on getting that buy-in at all.
Sure. Considering our treasurer was initiating this project, we had executive sponsorship, and it was much easier to get things lined up downstream. Now, what was unique was we used an internal director of cash who had experience working in Intel in all streams, from cash management to investments, hedging, capital markets, So having him as the project manager was very critical to the success of our first phase. Now, he had 3 other very strong professionals on the team and 1 IT resource from Treasury and a strong representation from accounting, all of whom knew the full working of quantum, which was critical for us. Now, when we had a similar structure in the terms of people for the SAP implementation. In addition, we had a strong consulting firm and excellent IT resources. I think key is to have Treasury people with knowledge of the end-to-end workflow leading the project. They are going to be the users. They need to be involved in every step of the project. And having strong legal and tax representatives is also important during the evaluation of the project and helping get the buy-in.
Jim, any thoughts from you on that people side of things?
I completely agree with what Deepa had said. I think a cross-functional project team is absolutely key for any implementation. You really, really need really strong subject matter experts from the tax, the legal, accounting, as well as the proper buy-off on getting the right consultants from and also strong IT engineers as well. And the one thing is in order to build support for this, I think for any multinational company, I think an in-house bank center is a must, right? There are just so many benefits of having an in-house bank that allows you to scale that we can't necessarily cover in a short webinar. But the amount of automation, I think, is pretty impressive.
Excellent stuff. And we are running a little bit short on time. So if you're listening and you do have a question for the panelists, please enter it into the box and we will get back to you offline. But I have a final question for each of the panelists, starting with Kelvin, if I may. What's your absolute top tip for making it a success of an in-house bank implementation, Kelvin?
I think, it's hard to just put just one. Because there's absolutely a lot of priorities and a lot of work streams. But if I may, I think the best is really to engage the partners early. I think Deepa and Jim will probably be able to dig into all the individual nitty-gritty ones. But from an external looking in perspective as a banking partner, I would say engaging all the different partners early in the game. And when the partners, I'm really talking about people like consultants, your internal partners like tax and legal and even banking partners as well, technology partners, So everybody has a role to play to make it a success. And I think this is absolutely key to make this a success story.
Early doors, definitely. And Deepa, your top tip, please.
I would say, besides the dream team working on the project, benchmarking with people is important. I mean, when we were doing it, we didn't have webinars to look at. So benchmarking with people, getting the right consultants, those are very key factors to have a successful implementation.
And Jim?
Yep. I think Kelvin hit it right on the spot. I think it's pulling in a very strong cross-functional team early to do the due diligence and be able to spend the time and to review each of the countries and then really document how you want this process flow to work, and then reviewing that with a lot of your consultants and IT staff and stakeholders.
Peter, final words from you.
Yeah, I guess I would just emphasize and repeat what was just stated. I think the fact that in-house banking solutions impact on so many different areas across so many different functions within an organization, it's absolutely critical to have strong executive sponsorship, strong leadership, and to engage all your stakeholders, internal and external. I appreciate the fact that Deepa said it's critical to get the right consultants. We think that is critical as well, to have the right people to be able to guide you and to help you, but having the team internally that is empowered and driven by strong leadership, and to get all those stakeholders to recognize and understand how their processes will impact on each other, how these structures will impact on the organization as a whole, is absolutely critical for success.
Yeah.
And one thing I would just like to throw in, Jim talked about we can't cover these topics in detail at the level that we would want to in an hour. Jim and I will be giving co-presenting on a case study with in a very short period coming up on the Microsoft implementation, their solution in much more depth. So that should be very exciting, I think, covering these kinds of topics in a much more granular manner. So we invite
Excellent
everybody.
stuff.
There'll be information about that in follow-up to this webinar.
Perfect. Well, that is us. That is us done. So thank you all so much for sharing your insights today. I know we've given our listeners a lot to think about, some actions to take away. And if you are listening and you'd like to find out more about any of the topics we've raised, please don't hesitate to contact the Serrala team. But yes, thank you. It's been fun and insightful.
Thank you, everyone. Appreciate it.
Thank you.
Cheers.
Thank you.
Thank you.
Have a great day.
Thank
Bye.
you.